Good afternoon, everybody, and welcome to our weekly Thursday webinar at 12. The noonday gun has just gone off in our Cape Town studio, and we're really thrilled to kick off yet another insightful webinar session. For those who don't know me, my name is Neil Peterson. I'm the founder and content in chief of Real Estate Investor, South Africa's premier independent real estate content, education, and news platform since 2007. And at REI, we're really passionate about serving the South African real estate investor, the South African real estate industry, and the property business community through our online digital platforms, rei.co.za, our monthly digital magazine, Real Estate Investor, and REI's webinars and our in-person seminars and conferences. And today I have the pleasure of serving as your host and moderator for our investment webinar. And we're really thrilled to have you join us for this insightful session. Today's topic is unlocking profits in property, the power of short-term capital investments versus traditional buy-to-let. So before I introduce you to our two expert investment panelists and delve into our discussion, first some housekeeping. And I do extend a warm invitation to you, our faithful attendees, to actively engage with us during this webinar, and your participation always enriches our dialogue. So please feel free to ask any questions you may have for our panelists. To ask a question, you just utilize the designated Q&A box. It's located on the bottom of your screen on the right-hand side, not the chat box that is reserved for general comments. So rest assured, all of your questions will be addressed during the Q&A panel discussion in our final session. We get this question a lot on recordings, and recordings of today's webinar will be accessible post-event via email if you've registered for this event. And if you've not registered, they are accessible on the REI website under events on the homepage. So you can get it there at any time. So let's move on to the heart of today's webinar, the power of short-term capital investment versus traditional buy-to-let. And we're going to explore the merits, the challenges of alternate capital residential investments compared to traditional buy-to-let investments. And our expert panelists will share their insights, their experiences and strategies as we help you navigate this dynamic landscape of residential investment. So without further ado, I'm going to ask our panelists to put on their cams, and our first guest panelist is Nick Morgan. He's the co-founder and managing director of Opportunity Private Capital. Nick, will you introduce yourself to the audience, please? And Nick, don't forget to switch on your
old dogs, new tricks. Morning, Neil, Jaco, and thank you for having me once again.
It's now Nick Morgan. It's afternoon, Nick.
Good afternoon. Good to be here again. Nick Morgan, co-founder and director, as Neil said, of Opportunity Private Capital. We're an 18-year-old investment company based in Cape Town. We provide, and our offerings incorporate capital investments to private investors, and this is in residential developments and other similar property-related products. And the fundamentals of our investments are quite straightforward. One is the protection of investor capital, which we're quite militant about. 2, high returns on investments. And 3, short investment time periods, typically anything from 12 months to 2 years. So, and fortunately, we've had a pretty long track record of good returns and good performances being achieved by our investors. So long may that last.
Wonderful. That's fantastic. Great having you again, Nick. It's always good having you on our show. And then, of course, also there's Jaco Grobler. He's the founder and CEO of Prosperity Enterprises. Jaco, you want to introduce yourself to the audience?
Good afternoon, Neil and Nick and the audience. It's great to be here today, and I'm very excited for the discussion that we are going to have. So as Neil has mentioned, I'm the founder and managing director of Prosperity Enterprises. And our business is to empower individuals to build and create wealth, to create financial freedom through proper structuring and property investment. So we help investors by teaching them how to invest in property, giving them the education, the tools, and the resources to build their property portfolios. We also help them with their structuring and in the journey of building their property portfolios.
Awesome. Great. Wonderful having you well, Jaco. Okay, so let's delve into the discussion, and we've got quite a lot to get through, and I think it's quite a debate, and I think it's a very interesting debate, and something which people are trying to work out. They're trying to get the solutions, and I think you two guys are the perfect two individuals on this particular discussion. So let's jump in terms of market comparison, alternative capital residential investments compared to traditional buy-to-let. So let's talk about how do the risk and return profiles, and we'll start off with you, Nick. How do the risk and return profiles of alternative capital residential investments compare to traditional buy-to-let investments in the current real estate market? And maybe, I think, Nick, just tell, maybe share with everybody what alternative capital residential investments are, because some people have a misnomer sometimes. So if you can maybe kick that off.
Yeah, well, I think firstly, Neil, it's a good question, because I think that risk and return really encapsulates, pretty much everything about investments. So, but just, I can only speak to the investments that we in particular offer, and the current capital investment that we've got offering is actually a capital guaranteed investment. So that alleviates capital risk to a large extent. And then you asked about returns. This one returns 14% per year over a period of 2 years, which is an effective 28% return on capital. So that's reasonably straightforward and reasonably easy to understand. I think alternative investments, to your question, Neil, is a very broad range, and it really encompasses almost all investments that don't form part of the traditional investment sector. And when I talk about traditional investment sector, I'm talking about traditionally with shares, bonds, equities, stocks, which have been around for a long time. So anything that's outside of that ambit seems to be labeled as alternative investments, which capital investments in property is therefore forms part of that.
Excellent. So I think a nice way to kick off. And I think, Jaco, we're going to put the same question to you. So you're sitting on the buy-to-let side of things over here. So let's talk about the risk and return profiles of the two versus each other. Alternative capital residential compared to traditional buy-to-let in the current markets.
Great. The first thing that a person needs to take into consideration is that when you are investing in property, and buy-to-let specifically, it's a long-term investment. So you're not looking at 12 to 24 months. You are probably looking at a couple of decades. And it's important to keep that in mind, because different investors have different needs. Depending on the needs that you have, you're going to make different investments. So with a buy-to-let strategy, it's much more consistent income. I mean, if you look at the last 50 years, property price in South Africa has consistently grown for 50 years. There's 3 years in the last 50 years where property prices actually declined and recovered almost immediately after that again. So it's a much more consistent return. But it may also be a lower return unless if you are getting creative. And something that we had to do the last decade, especially because the last decade we haven't seen great capital appreciation. I mean, currently property is growing at about 3% a year. So if you don't do something creative, you're not going to generate good returns. Is to become creative within the traditional buy-to-let space, and to start looking at different kinds of buy-to-let strategies to increase your yield and to increase your total return that you can generate on a buy-to-let strategy.
Okay, I love your creativity analogy. I think it's great, because I think that's key. I think in any sort of strategy, and whether it's buy-to-let or whatever it is, creativity comes to the fore. So Nick, let's talk about liquidity, accessibility. What are the key differences in liquidity and accessibility between alternative capital investments and traditional buy-to-let?
Well, again, on the capital investments, Neil, I think even in traditional buy-to-let, liquidity is sound from the point of view, and Jaco will attest to this, from monthly returns, but the potential exit of those investments might be a bit more difficult. And the same with capital investments. They're not immediately liquid investments. That is not a trading platform. So with this particular investment, for example, for us, if an investor chooses that he would like to exit earlier, he must give a few months notice, and then on a best efforts basis, we can then help them exit and find someone to replace their investment.
Okay, excellent. And then from your perspective, let's talk about liquidity from your side, from a buy-to-let perspective, Jaco.
Traditionally, it's very difficult to get your cash out because you are sitting with a fixed asset that actually needs to be sold to get your as Nick said, to exit. But as property investors, we've started looking at different ways to create more liquidity and accessibility. And one of those ways are to refinance. And something that I always tell my clients are, if you are sitting with a property portfolio, always refinance that property portfolio to 100%. Now, I'm not saying to leverage 100% and to use all of that money, but always make that money accessible. And the way that you do that is by taking your buy-to-let property, refinancing it to 100%, and taking that cash and actually parking it in the access bond. Because by doing that, you are creating a lot of liquidity in an investment that is actually very illiquid. Because at any given stage, you can access the capital of that investment by accessing the equity which has been turned into cash and which is parked in the access bond. And then the nice thing about that is, while this cash is parked in the access bond, you are not paying interest on this money. So you've got your bread buttered on both sides. On the one side, you're not paying interest on this capital, but on the other hand, you've got access to that capital if you need that. And that access can be used for repaying loans or money that you've pushed in, so you can actually get the money that you've pushed into your property portfolio out. It can be used to subsidize shortfalls if there are shortfalls on the property investment. It can be used just as a reserve for safety if something goes wrong, or it can even be used to expand your property portfolio and to build your property portfolio further.
I think the key is, Jaco, not to access that capital and go on a fancy holiday overseas.
Absolutely.
And I think and we looked at 2006, 2007, and we had a crash in 2008. And I think we saw a lot of people that had this irrational exuberance, is the word. And they thought it was never going to end, because we had probably one of the best property booms from 2002 to 2006, even beginning 2007. And everybody went on a spending spree. So I think very, very sound advice there, Jaco. So thank you for that. So Nick, let's talk about...
Are you still regretting your last holiday, Neil?
Not at all. Fortunately, I used to try and when I say used to, I'm still doing it. I've learned from that kind of practice of being very careful about it. So about where you use that money and and I think Jaco said it. If you access that capital, make sure you use it either to pay whatever you put into the property and not to use it outside of the investment. That will come later. Your returns will come later, where you will be able to expend it on other assets and other expenses like holidays and that kind of stuff from the profits that you will make. And remember, today we're talking profits, guys. So we're talking about unlocking profits. So Nick, from your side, let's talk about the income generation between these two strategies, and particularly from your one.
Well, income. So there's a stark difference between the two. Because with these capital investments, there is no income generation. One has to ride out the term of the investment in order to get your capital plus your returns back, which obviously, as Jaco's going to tell us now, is one thing good about buy-to-let is, of course, you get that income generation, so you get that immediate cash flow. But having said that, and I just want to point out, it's all about context. And the reason I believe that our investment offerings have been successful, particularly in developments, etc., is that developers are not constrained by cash flow requirements. Because these investments pay out at the end, it's a much safer avenue to tackle for development companies because, as I said, their liquidity, their cash flow is not compromised.
Okay, great. So Jaco, just share a little bit about the cash flow expectations and how they differ between alternative versus traditional buy-to-let.
I sit with clients on a daily basis that share with me their goals of what they want to achieve with their property portfolios. And a lot of clients want to replace their income. That's the ultimate goal for them. I'm earning X amount through working for a company or whatever you do. And I would like to replace that with cash flow from my property portfolio. So often when we sit with our clients, we look at their structuring to set up a structure that can actually be used to achieve that. And then we look at income generation and we look at cash flow. How can we maximize cash flow? Now, traditionally, you would usually start with a shortfall in the beginning in a traditional investment. So you would buy an investment and you would actually have to pay in the first number of years. And later on, that would start becoming positive as rent has escalated, et cetera, et cetera. So you would start getting an income. And then obviously what a lot of people do, they pay off their properties and then you don't have a bond anymore and you have significantly more cash flow on a monthly basis. So that's a very traditional approach. But over the years, we've also gotten creative in the way that we look at cash flow and that we look at that because one of the first things that we do and what we try to achieve as property investors is we don't want to have a shortfall, because if we have a shortfall, we immediately limit the size that we can build our property portfolio because we've only got so much cash to push in. So one of the ideal places to reach is to acquire property that's not going to cost you any money. Now, in order for you to acquire a property investment or a buy-to-let investment that's not going to cost you any money from day one, you have to be creative. A traditional vanilla buy-to-let is not going to generate that for you. So you're going to have to look at something creative. You're either going to have to look at a multi-let where you are renting out rooms in a property, or where you are renting out multiple units on an earth, or you're going to have to look at student accommodation, which actually is also a form of multi-let. You're going to have to look at low cost housing or affordable accommodation, or you're going to have to look at buying buildings where you are renting out multiple units out of one block. So you're going to have to get creative. You're not going to generate that positive cash flow from day one otherwise. That, however, does not mean that your traditional approach is wrong. Yes, it's going to take you some time to reach positive cash flow, but eventually you will achieve positive cash flow, and eventually that cash flow can replace your income.
Yeah, great. I think, a lot of people are struggling, and I say people, investors that have jumped into the buy-to-let sector and, not knowingly using your strategies there, Jaco, and they're sitting with shortfalls. And I think, with the high interest rates that we have, and I'm confident that interest rates are going to definitely come down in September, and that could make a significant difference. I think that certainly is one thing there. So let's talk a little bit about the regulatory environment. And I see, Nick, there's a question already on that one. Is yours a legitimate product? And but let's talk about what are the major regulatory and legal differences between investing in the two: alternative capital investments versus traditional buy-to-let.
Neil, I can't speak for all alternative investments because they all differ somewhat. But in terms of our specific capital investments, so Opportunity Private Capital has an FSP license. So its conduct is regulated by the Financial Services Conduct Authority, or FSCA. And with this particular investment offering we're talking about, a prospectus was submitted to CIPC. It's been authorized by CIPC. So we operate in a pretty stringent regulated environment.
Okay. Well, that's good news, because certainly I think it's so important nowadays compliance is such a big thing in investing. So you just cannot, get through and jump through all these different hoops that you have to today. So Okay, so I think you've helped Graham also sort his question. Graham, hopefully we've answered your question there, but you did ask a specific one, which we can come back to a little bit later in terms of ITB certificates, whether you supply that. So let's talk about initial capital, ongoing costs for buy-to-let, and Jaco.
Great. So again, as a property investor, one of the first goals that I have is how do I acquire property with as little capital as possible? I mean, that's the big advantage of property investment above any other form of investment, is the fact that you can actually use other people's money. You can use the bank's money. So I would always apply for a 100% loan when I acquire property. And I would always try and use as little of my own money as possible. Because by doing that, I can build a property portfolio or an asset base much bigger than what I would have been able to build with my own capital. And that's a very, very big advantage of property investment. That's probably the biggest advantage for me to traditional buy-to-let investing, is the fact that you can do it with very little of your own capital.
Okay, great. So let's talk a little bit more about diversification, risk management, how investors can effectively diversify, manage risk in alternative capital investments on your side there, Nick.
Sorry, Neil, do you want to speak to the first question? I think you asked a question which I didn't get a chance to rebut.
Okay, so you obviously want to talk about the capital and the ongoing costs. Is that what you want to sort of revisit?
Yeah, because I think
you're happy.
Think it's important.
No, absolutely, it is important.
Yeah,
So
I don't appreciate being glossed over like that, Neil.
Well, you know what? I think, Nick, that's the whole purpose of this discussion, is that I encourage you to please. And if there's something that you want to add in that, please add in your bit to there.
Yeah.
So I welcome that into the discussion. So let's talk, because in your business, it's very important.
I think sorry to jump in there. There's a bit of a delay on my side, so I apologize. But I think one of the great advantages of these capital investments is simplicity, because once you invest your capital, you let other people do the hard yards. And you don't need to manage. There are no ongoing costs, because once you pay your capital, that's what it is. The returns are quoted net of fees. So the return that's being offered is the return that one is going to receive. There are no hidden costs that are going to come and bite you down the line. So you don't need to worry about future cash flow during the course of the investment. So from that point of view, I think it makes it quite a simple investment, that once you vest it, you can let it be and hopefully reap some really significant rewards at the end.
Yeah. So I just want to add to that, because you mentioned earlier about this sort of the normal alternative capital investments. In other words, not opportunity private capital.
Yeah.
Because we see that the costs can get quite excessive. I mean, if you're going into a non-sort of traditional thing. So maybe just to elaborate a little bit on that difference, because your product's very different. It's not the traditional, as we say, it's traditional buy-to-let, but it's not traditional alternative capital investment. Am I right in saying that?
I think you're right in some senses, Neil. And there are a few things to unpack there. One is it's not traditional capital investing in the sense that it is in a regulated environment, whereas obviously many alternative capital investments operate outside of a regulated environment. So that's the first thing. Two, we are very conscious of the fee encroachment. So when we're very conscious of people offering certain returns, and then the small print will impact them because they haven't read that certain costs are going to be taken off their returns. So that's another advantage to what we do, is it's pretty transparent from that point of view. And the other thing in terms of traditional, alternative investments, Neil, and it's a bit off topic, but the mechanism to which how the returns are generated in our investments is very transparent. and very straightforward to understand. Whereas I think a lot of investments, and I think even in the traditional sector, where the mechanism or how the returns are generated is not obvious. And I always say, if you don't know how the money's, how the money's being made or how the returns are being generated, you got to ask some questions, because you have to understand your investing. And that's why, just to go back to Jaco, for example, he sounds like he coaches his clients, he talks them through so they understand what they're investing in. And our team are exactly the same, is that people understand exactly how these investments are generated, which I think is rare.
Okay, no, good. I think valid point. So let's talk diversification and risk management. From a buy-to-let perspective, how can investors effectively diversify and manage their risk? Jaco?
I think that's actually a disadvantage of buy-to-let investment, is the fact that you're not very diversified, especially when you start out, because you've got one property, it's located geographically at a certain place, and you've got no diversification. And then as you grow your property portfolio, obviously you start diversifying more. But then you need to ask yourself the question if that diversification is good for you or not, because property investment, or the traditional buy-to-let investment, is not a hands-off investment like with investing with Nick. So you are going to have to be actively involved in building this property portfolio. You're going to have property managers, you're going to have plumbers, you're going to have electricians. And if you diversify geographically, it means you are going to have to build up this list of service providers, both in, for example, Cape Town and Johannesburg, if you want to have property in both cities. So I personally have gone the approach where I'm not very diversified. Many of my properties are in close proximity to one another. Now that is a disadvantage, but the advantage is economies of scale. The fact that I can manage the properties much better and generate much better returns because of the fact that they are in close proximity to one another. So I think it's very much the approach of what Warren Buffett often would speak about, is he doesn't necessarily have that many baskets with eggs in, but the few baskets with eggs in that he does have, he's keeping a very close eye on.
Okay, nice analogy. So Nick, your response to the diversification and risk management for ACI?
Yeah, so this is a really interesting conversation, and one which I think the word diversification, I think people get a bit confused. Well, not confused, they maybe take it too literally, but I have particular thoughts about it. So Jaco's point, really well taken. You can diversify and buy-to-let geographically, or you can focus on certain points. But I actually think the capital investments in property and the buy-to-let almost go hand in hand, because I'm a fierce advocate. I'm a fierce advocate of diversifying within an arena that you understand. In other words, you can understand property really well and diversify in different kind of investments within the property sector. Almost all successful investors, certainly the ones that I know about, are successful because they've stuck to a sector that they understand, and they're able to leverage their knowledge accordingly and build wealth from that. I'm not an advocate. I'm not an advocate of people diversifying for the sake of it, and they've got some money in crypto, and they've got some money in equities, and they've got some money in property. And what that tells me is they actually don't know anything about any of those arenas, and it's a bit of pot luck. So stick to an arena that you like and you know well, and diversify potentially within it, and you'll do very well for yourself.
Red or black?
Mauve.
I just thought I'd just throw that, red or black, because it's a bit of a gamble, isn't it? So,
Neil, I'll jump in there. I think it's a gamble. Yes. Yeah, it's a gamble if you don't have in-depth knowledge about the arena in within which you are investing. That's when it's a gamble. That's why, rather, as I said, again, to repeat, diversify within an investment arena that you understand and leverage that knowledge.
Point taken. Good point made. So, Jaco, let's talk about the market trends and economic factors. And of course, we've seen, that impact in the last couple of years, investors quite, in quite a significant way, because we've had sort of interest rates going up and down and that kind of stuff. So maybe do you want to just talk about, what are the current trends and the economic factors influencing traditional buy-to-let?
Great. So I'm going to use a practical example, and then it's actually a negative point to start with, but then I'm going to explain to you how you can actually utilize that to make a good investment for yourself. I used this example previously, but I just recently bought a property in Sunninghill in Johannesburg, 2-bedroom, 1-bathroom apartment, and I paid 660,000 Rand for that property. An exact same property in a sister complex 10 years ago, I bought a property for 760,000 Rand. So in 10 years, in Gauteng, the value has actually declined with 100,000 Rand. And this last decade has really been tough on property investors, especially in Gauteng. The Western Cape has shown good capital appreciation, but in Gauteng, there's been almost no capital appreciation in the last 10 years. And that has gotten a lot of investors despondent to say that, does property investment really work? Is it still worth it to invest in traditional buy-to-let investments? And there's a couple of things that I want to point out. The first thing is that I don't like to look at a time period of less than 20 years, because if you take any 20-year cycle in the last 60 years of investing in property, you will get a capital appreciation of in the vicinity of 10%. So any 20-year cycle will show you very good capital appreciation. The last 10 years, however, has not been good. That may be an indication that somewhere in the future we could see much better capital appreciation again, purely because of the fact that costs are going up, labor is going up, costs of raw materials are going up, building costs are going up, so property prices has to go up at some point. So those things move in cycles, and it's important to be aware of those cycles. So that's the one thing that I want you to keep in mind. But then the other thing, and I said it previously, is the poor returns that we've seen in a traditional vanilla rental has forced us to start thinking creatively in the investments that we make. The properties that I invest in now generate a gross rental yield of more than 20% for me. And the reason for that is because we aren't doing traditional vanilla rentals. We are operating in a creative space where we are looking at student accommodation, where we are looking at short-term rentals, where we are looking at low cost or affordable accommodation, and where we are looking at multi-lets. So the moment that you start looking at different types of investments, suddenly you can be in a place where your returns are looking much better. So last decade, not good for traditional property investment at all. Will it get better? Probably.
Okay, that's good news. Right. So you talk a little bit about those market trends and economic factors in your investment, Nick. Would you just elaborate a bit on that?
I think I think investments is really based on perception, and it's a perception of the environment, which will be political, economic, etc., etc. And that drives a lot of what people or motivates people to invest in certain things. With property, and whether you're buying a buy-to-let property or you're investing in capital investments such as ours, which are within the property sector, there's one very important factor that drives it, and that is solidity of infrastructure. And the solidity of infrastructure is governed by the local government, or whatever country or province it might be, is governed by the people who run that area or that environment. That's what creates a positive perception. Jaco mentioned the Cape. That's why the Cape is experiencing a boom, purely because the perception is, and I think quite rightly so, the perception is that the infrastructure, the service delivery, the local government is good, because property relies on that as a security factor for it. So we, as example, we focus our investments purely on the Cape area. We have for the last 10 years, purely because we feel strongly about the fact that infrastructure and positive perception in the property environment is integral to how we present our investment offerings. And I think that market trends and perception also play a decision in terms of your short and long-term planning. Now, and Jaco has quite rightly said that buy-to-let property is a long-term game. That's where you're going to leverage your returns. In South Africa, people are, whether we like to admit it or not, people are generally a little bit uncertain about what the future holds. They just don't know. And because of that, it's difficult for them to extrapolate a time horizon which is too far ahead because they're just not sure. So I think the investments we offer are advantageous to that point because people can make shorter term decisions, not feel that they're hemmed in for an extended period. So I think these decisions get really, really based upon whether people are looking at short or long-term horizons.
Okay, great. Okay, nice answer to that there, Nick. So our theme, and our theme is unlocking profits in property. I mean, this is key. So just before we get to that question, the audience, if you got questions, please fire away. Just drop it in that Q&A box here. I see we got a couple that have come through, but we welcome more. I mean, we got our two experts over here who are dying to answer your questions and definitely help you along the way. So don't be shy. There's no such thing as a stupid question. Please fire away. So we're talking about unlocking profits in property. Now let's talk about ROIs and appreciation. And you touched a little bit on it there, Jaco. So maybe let's talk about how do ROI and potential property appreciation, how does it apply and compare? Well, we don't want to do a comparison, but certainly from a buy-to-let perspective. Maybe you can share that. How does that ROI potential look like?
Thanks, Neil. In property investment, you've got two returns in a traditional buy-to-let investment. On the one side, you've got the capital appreciation. That's the value that the property appreciates by every single year, which is one part of your return. And on the other side, you've got your net rental yield, which is the return that you are generating from the rental income. Now, when I started investing in property 15 years ago, I primarily focused on capital growth and appreciation. And I think that was a mistake, especially because we haven't seen the best capital appreciation in the last 15 years. So the last couple of years, my focus has shifted quite intensely to the cash flow side of things and the income generation, the net rental yield. And where we've, rather than trying to depend on the capital appreciation, something that we have no control over, we started asking ourselves, how can we generate more income from the buy-to-let properties that we own? And we started looking at ways to generate a better cash flow, to generate a better net rental yield on the property. And that has worked greatly. So I want to say again, capital appreciation is there. And even though it might be low the last 10 years, any 20-year, consecutive 20 years has shown very good capital appreciation. So as I said, you can see a capital appreciation averaging per year on about 10% if you are taking any 20 consecutive years, which is a very, very good return by itself. And then over and above that, you still got the net rental yield. Now, your net rental yield can be anything from 4% in a city where you've got, like Cape Town, for example, where you don't necessarily have the best yields, but you've got good capital appreciation, to 6 to 8% in a place like Johannesburg. And that is with a traditional buy-to-let. That can be pushed up significantly, over 10%, even 15%, when you are getting creative and you are looking at some of those alternative buy-to-let strategies that I discussed previously.
Okay, great. Excellent. So Nick, I see a few questions that come up. We can go into a lot more detail about the product because I think people are really trying to understand it. But ROI, I'm playing right into your hands, right? And appreciation. And I know
REI or ROI, Neil?
No, OI. Return on investment.
I'm just teasing you, Neil. Neil, look, simply put, I think buy-to-let investors have a long-term time horizon, which is perfectly fine if that's your objective. And admittedly, over the long term, buy-to-let investments very successful if you find the right properties. With the capital investments, shorter time horizons, but that doesn't mean it ends there. So you know, our particular, let's take this investment, you know, it's paying 14% per annum. It's projected at a 2-year time horizon, but it doesn't end there. We have further offerings where people can reinvest. And a case in point is that, you know, we've got investors who've been investing with us in these particular and types of per annum return investments for over 10 years. And they generally go from one investment offering to the next, and they reinvest. And we're fortunate we've got a retention rate of investors of over 70%. So that means a lot of people sustain their investments by going into further offerings. So even though the initial time horizons are short, there is obviously the possibility for sustained investment. So you can build it like that.
Okay, excellent. Great. Let's talk about management and maintenance. Now, it tends to be the bane of many investors' lives. They realize that, you know, these are two key things in running your property. And certainly buy-to-let, it is a key thing. So maybe just talk about a little bit about that from a buy-to-let perspective there, Jaco, in terms of how you would manage and maintenance. And typically, I think we're talking here, alternative capital investments is a hands-off approach, whereas buy-to-let is very much a hands-on approach. So maybe just let's dig in a little bit about the management and maintenance in buy-to-let.
I want to reiterate again, a lot of people think they're going to buy property and forget about it. And it's exactly what you said, Neil. It's not a hands-off approach. When you are building a property portfolio, you are going to get involved in that property portfolio. Now, that doesn't necessarily mean you're going to have to do it yourself, but you're going to have to factor this into your returns. Look, I've got no idea how to fix a toilet myself. We have a large property portfolio that we own today. I don't even know how a toilet works. I don't know where the water comes from, where it goes, how the flushing mechanism works, none of it. Yet, I own property. So that doesn't necessarily mean that you need to fix the properties yourself. I always laugh. One of my friends that said, you know what, I'm done investing in property. I'm tired of getting a call on a Friday night about a geyser that burst or a toilet that is leaking. I don't have those problems because I've put the systems in place and the people in place to take care of those issues. So we always talk about property investment, building a competent team around you. And one of the very, very important team members that you are going to have as a property investor is a handyman. He's somebody that can fix the things that needs to happen. Is there maintenance on buy-to-let investment properties? Absolutely. Do you need to provide for it? Absolutely. What I usually do is I've got 12 months of rental in a year. I allocate 1 month's rental to vacancy because my property is not always going to be full. And I allocate 1 month's rent to maintenance. So I effectively work on 10 months rental income when I look at my property portfolio.
Okay, great. Wonderful. I think nice way of putting it. And certainly yours is an easy answer there, is it, Nick? Or is it not that easy? Is it completely hands-off?
Neil, it's incredibly short, sweet, and straightforward. There are no management or maintenance hassles with our property. Other people do the hard yards behind the scenes, while you quite rightly sit and let your money work for you.
Awesome. Okay, great. Nice, easy. And we get those wonderful returns that you were talking about earlier on. So, okay, before we get into the questions, I want to get into our last question. And so the way we'll play it is we'll play this last question. We'll discuss it. Let's deal with the questions. And then we can end off with a wrap with you, Jaco, and you, Nick, with your final thoughts. And once again, to the audience, if you've got questions, more questions, please submit it in the Q&A box. And so let's talk a little bit about the long-term viability and common exit strategies for buy-to-let properties. And you touched on it a little bit earlier on as well, Jaco, but let's just revisit that a little bit more, because some people, you know, tend to buy, flip, you know, there's different strategies that you can apply and that kind of thing. So maybe you talk about what you think is really a good strategy, a viable strategy from longer term and exit strategy, because you also spoke about longer term as well.
We've got a very nice video on our YouTube channel, on the Prosperity Enterprises YouTube video, a YouTube channel. And the name of the video is, does it still make sense to invest in property in South Africa? And I'd like to touch a little bit on some of the things that we discussed there, because is there long-term viability in investing in property, and how does your exit strategies look like? Now, let's talk about the viability first. Does it still make sense to invest in property in South Africa? Absolutely. Why is that? Because there are great returns. There are great returns that you can generate. Not only that, there's also the economic fundamentals that play in your favor. There's always going to be demand for housing. I mean, our population is continuing to grow, and every single person needs accommodation. So the need or the demand for property is going nowhere. There's the opportunity to buy properties at great prices, and that's why I continue to buy, especially in markets like these. And then lastly, which I discussed earlier, is you can actually build this massive property portfolio without using any of your own cash, by using the bank's money. So does it make sense to invest in property? Is there long-term viability? Absolutely. What about exit strategies? Now, when it comes to exit strategies, there's a couple of things that you need to consider. When I'm looking at property investing, I'm thinking of it generationally. I want my children and my children's children to benefit from the investments that I'm making today. And thus, I've put up a trust, I've put up a company, I'm buying my properties in a company, I'm making sure that that company share sits in a trust, so that it can go from generation to generation to generation, so that I don't have to exit. So that's one way to look at it. The nice thing about structuring your portfolio like that as well is you can sell the entire company. If you get to a place where you do want to exit the property space altogether, you can actually sell your company with all your properties in. So structuring also becomes very important from an exit strategy as well. Otherwise, it can become difficult to exit, because you actually need to sell each property separately, and there's a lot of costs in selling property as well.
Okay, great. So your one is a little bit more sort of straightforward there, Nick, as well, from, long-term viability and exit strategies, a bit more simplified.
Well, I think in terms of long-term viability, Neil, there are two ways to look at it. So there's long-term viability in the investments themselves. So I mentioned it earlier, the investment time horizons might be quite short, but they are sustained because future offerings come on stream all the time for investors to invest in. The second part of viability, I think, speaks to the environment that you're in. That's what makes something viable, right? So from our point of view, as long as there are developments coming up in decent areas of the country, or wherever it is that we choose to invest, then for the foreseeable future, there's long-term viability, because those investment offerings and the ones we package are always going to be around if those environmental factors remain okay. Then you spoke about exit strategies. So exit strategies, I think, on our side are a bit easier. We don't generally get many investors who wish to exit earlier than the term of the investment. And I think that's purely because the time horizons are quite short anyway. And most people want to maximize the investment for the full term, be it 12 months, 18 months, 2 years, whatever the case is. So the exit strategies that people adopt are generally very straightforward. They wait till the end of the term and then decide what their next step is going to be.
Excellent. Great. Okay, now we're going to deal with the questions. And there's quite a few, and some comments as well. So I think, Yaku, there's a comment here from Anonymous. It says, did Yaku say to refinance and leave it in the bond? And if not used, in other words, you don't use the refinance cash, then bond payments won't go up. So I don't know if you would just want to comment around that there.
Yes, absolutely. Absolutely. We've got a very nice article on our website, prosperityenterprise.co.za, where we speak about how to use your access bond. Now, I love an access bond, because the thing about an access bond, like I said, is you've got your bread buttered on both sides. You've got access to the capital, but you don't pay interest on the capital. So any capital that you put into your access bond, reduces the capital outstanding on which the interest is being calculated. So one of two things are going to happen. Either your payment is going to stay the same, but a bigger portion of your payment is going to be allocated to capital, meaning that you are paying the bond off quicker. Or alternatively, and this is the one that I always opt for, is your bond payment actually comes down. So the more money that you put in your Access bond, the lower your monthly payment, bond payment becomes. And that's good for me as a property investor because I'm off the cash flow after all.
Okay, absolutely. I think that's a nice way of putting it there. So I'm going to double up on a question now for you, Nick. And the one was from Graham, and the other one from Ntasili. So the one is, and you also did touch on it a little bit about being a regulated product. Do you issue IT3Bs to investors? That's the first question. But let's link it to, is there a minimum amount one must invest in the short-term investment? And are the stated returns guaranteed? So, and we get this a lot, don't we?
Yeah.
Is it guaranteed? Because I want that money and it's got to be guaranteed. If I don't get it, because I want if Jaco can guarantee it, because there's a lot, unfortunately, of communications, particularly and in the investment industry where they're saying you're going to get X amount of returns.
Yeah.
And
so I think
many cases don't get it. So two sides to the question. The regulated product, issuing the IT3Bs to investors, and then of course let's talk about the minimum amount must invest and the stated returns guaranteed.
Yeah, so let's tackle IT3Bs first. We issue at the end of the investment, we issue investment statements that are signed off by the investor. They've also got a certificate in this form. They are debentures that are issued by the prospectus that's approved by SIPC. So they've got both of those. We don't issue a specific IT3B at the moment. We haven't been asked to do that by SARS. So that's the first thing. Neil, you've disappeared. Yeah.
No, purposely.
The second,
I'm back.
You're back. The second part of the question, I think, was to do with the minimum investments amounts. So these investments start at 100,000 Rand, and anything upwards of that is taken on.
Okay, great stuff. Thanks.
Was there another? I thought there was another question as well, Neil. Was there a third part to that?
There is. That's going to come up. I mean, the one was obviously the minimum amount, and then of course are the stated returns. I think that's the key part.
Okay.
Are they
guaranteed?
returns?
Okay.
Guaranteed.
Yes. Okay.
Yes.
So no. So this is really important to us. The capital is guaranteed. So again, the premise of our business is always, first and foremost, the protection of invested capital. We don't guarantee the returns. However, having said that, over the last over 10 years, while these particular per annum returns have been in place, the projected returns have been paid out on every single occasion with absolutely no exceptions.
Okay. Well, I think that's what people want to hear. I think that's important. I mean, that's testimony to, probably better testimony than anything else at the end of the day. So, and the investors are getting their returns, what they were promised. There we go. Okay. So, Jaco, this is a comment. It's from Daniel, and it's quite a lot of words here, but let's run through it. And then I think maybe if you could just give your response to this comment. So with any property investment, it's important for the investors to know why they are investing in property. Cash flow should be a secondary benefit. The initial benefit should be the long-term replacement of income upon retirement. Shortfalls are far less than, what is retirement? Sorry, that's another discussion. Shortfalls are far less than what is needed for an RA that provides the same capital versus capital growth. And then the last comment associated with that, correct structuring is important for keeping the assets out of one's estate. So there's quite a lot in there. Your thoughts?
Yes, it's thanks for that comment, Daniel. I think it's very true what you are saying. first and foremost, you do need to understand your why. You need to understand why you are doing it. What do you want to achieve by this? Because if your why is not strong enough, you are gonna get distracted along the way. So you do need to have a very strong why as to why you are pursuing this strategy of investing in property. And then I like what you said about the cash flow. There are different opinions to that, though. Some investors would say capital growth should be secondary benefit and cash flow is primary. So there's actually a lot of investors that aren't considering the capital growth at all. They call it the fifth quarter. It's a benefit. If it comes, it's great. But if it doesn't come, the capital the cash flow that we are generating out of that property from a monthly basis is more than sufficient. Now, you can think, Daniel, if you can make an investment that doesn't cost you anything, any of your own money, and that investment is generating monthly cash flow for you, that's a fantastic investment, irrespective of whether the capital is appreciating or not, the capital growth, whether there's capital growth in the property or not. So traditionally, I agree with you, and that's the approach that I started with as an investor as well. Cash flow is secondary. I'm focusing on capital appreciation, but it's not the only approach. There's actually many investors that make cash flow their primary benefit, and capital growth is secondary. So when you invest in property, you always need to consider both the capital appreciation and the cash flow components of that investment, and also know, again, your why. Are you going after the capital appreciation or are you going after the cash flow? And I couldn't agree with you more, Daniel, that correct structuring is critical. And that's something that we can help you with at Prosperity Enterprises as well, is to set up your trust in your companies to make sure that you have asset protection, number one. Number two, that you've got the estate planning benefits, as Daniel said, that you don't pay a lot of costs on death. Number three, that you have the financing capability to actually get financing for more properties. And number four, that you take advantage of the many tax benefits that there are with the correct structuring.
Okay, excellent. Great. Thanks for that, Jaco. I see one of your fans here, Nick Anthony, he said, considering the difference in returns between individually buying to let and OPC's returns and the downsides of owning a property and managing tenants, why would you not go with Nick Morgan of OPC? So the gauntlet has been thrown down over there, Nick. So I don't know if you want to comment on that. And Jaco, you're allowed to respond too.
I think I'd be doing a disservice by commenting, Neil. I think it says it all.
Wonderful.
Yeah.
And I don't know whether there's a retort there from you, Jaco.
Yes, absolutely. I think that's great. And what Nick said, the fact that they've been able over 15 years to always give the return that they promise, as you said, that speaks for itself. I think there's different investors with different needs. There's a lot of people that want to build wealth, but they don't necessarily have capital to invest. And property is a great way to invest if you don't have capital, because of the fact that you can use other people's money. So look, the IRR that we generate on our property portfolio and that we can generate is massive. My geared internal rate of return is over 20% on my property portfolio. Now, what that means is the return on the cash that I actually put in, I get a return of over 20%. But I do that with a lot of leverage. I do that with using the bank's money. I'm actively involved in my portfolio. So you do need to take those advantages and disadvantages into consideration. So there's definitely advantages and disadvantages in both approaches. But I think more importantly, it goes about your needs and where you are at and what you want to get out of an investment.
Wonderful. Good. Gentlemen, I don't believe it. It's almost 1 o'clock. It's the bewitching hour. The time has disappeared. It's just arrived. So what I would like to do is each one of you, if you could give us your final wrap, your final thoughts, leave the audience with something that they can take away. I think it's been a really insightful discussion, and I must thank both of you for really adding value to that. And yes, we've got some people going to lean to the one side. There's going to be other people that's going to be lean to the other side. And it all depends. It all depends. And that's the big question. And it depends. Because at some stage, there's always somebody that is looking for your particular kind of product. So ending with you, Jaco, do you want to give your last bit, and then Nick, I'll give you the final word, and because you had a lot of cryptic answers there, but Jaco, you can end off just before Nick does, and maybe give your final thoughts to the audience there.
Thank you, Neil. So let us at Prosperity Enterprises help you with your journey to build your property portfolio and to become a successful property investor. Reach out to us. You can email us at info@prosperityenterprises.co.za, and we'd love to assist you with that. Make sure that your structures are right. When you want to invest in property, make sure that you've got your holdings trust, you've got your property company in place, and that you start your property portfolio correct. And if you've started already, we can also help you not just to set up your structures, but to restructure your property portfolio. So if you are sitting with properties in your own name, let's get the foundation, let's get the basis right, and let's go get those properties restructured into the right entities, and then have be intentional about consistent. Often I sit with somebody, then they're 45 years old, and I tell them, you still have 20 years of active property investment ahead of you. So don't look at the 45 years lost, look at the 20 years ahead of you that you have to still, and there's a lot that you can do in 20 years. So if you consistently, and that's the key word, consistency. If you can be consistent in building your property portfolio one property at a time, you can replace your income with passive income from property investment, more passive income rather, and you can replace your income with the cash flow that your property portfolio can generate for you.
Wonderful. Jaco Grobelaar is the founder and CEO of Prosperity Enterprises. Nick, the floor is yours. Your final thoughts that you want to leave the audience before you go.
Thanks, Neil. Thanks. Firstly, if I don't get the chance to say thanks very much for having me on. I've enjoyed the chat.
Pleasure.
Very insightful. Thank you. I'll finish off with in two sections, Neil. The first one being that it's a general comment, and I've found that over the years I've met many investors who, in South Africa in particular, who sit on the fence for quite an extended period. They don't know which way to go in terms of what to invest in, and time then passes them by. And I think my philosophy is very simple. My suggestion, should I say, is if you've done your homework, doesn't matter what you're investing in. Could be in the more traditional side, it could be the more alternative side, buy to let, doesn't matter. If you've done your homework and you're satisfied with the homework, don't wait for the perfect environment. It may never come. Pull the trigger and do what you need to do, because the greatest risk is taking no risk at all.
Absolutely. Take action. That's it.
Yeah. And then
Definitely.
just from our point of view, we've got, as I said, we've got our current investment going at the moment, our 14% per annum capital guaranteed. I know the consultants are busy with a lot of people. They're filling up fast because it is a finite investment. There are only a certain number of spots available for this particular investment. So if guys want to reach out to the Opportunity, it's www.opportunity.co.za if they want any information from there. But anyway, thanks once again. Been great fun.
Wonderful. Thank you. So, yes, so once again, thank you to our panelists. That's Nick Morgan. He's the CEO and founder of Opportunity Private Capital. And of course, Jaco Grobelaar. Thank you very much. I think it was a great, insightful discussion, and I think it's to be continued. I think we really need to unpack it. And you can see there's definitely a need for investors to really understand, to be led and to be guided in terms of their investments sort of going forward. So, and thanks to you guys for doing that. It's been wonderful. Just before we close, I just want to remind our audience of our next webinar. So there's not going to be a webinar next week. As we just recently this morning, we just got that the webinar will be moved. It was going to be next Wednesday. So there is no webinar next week because Friday is also a public holiday. It's Women's Day. And so our next webinar will be on Thursday, the 15th of August at the same time, 12 o'clock, our normal Thursday slot at 12 o'clock. We're going to be looking at strategic UK investing and what South African investors need to know. And so we will cover the most promising property investment opportunities in the UK with leading experts. So that link will be, I don't know whether Ashik, my colleague, has got that link already. If you could drop that into the box and register there, I'd appreciate that. If not, just go onto our website and we will send out communication to everybody, those of you who are interested in attending. Alternatively, just go to our website on the homepage and then we have it there. Now, an audience, to all of you, thank you. We appreciate your active participation, your questions, your engagement throughout has been wonderful. We know that you've not only gained valuable knowledge and you'll act on what was shared today, as Nick and Jaco pointed out, and I encourage you, if you want to reach out, you can also go to just send us an email at info@rei.co.za, or as Nick welcomed you to reach out to him directly through their website, and Jaco as well. And so if you need any one of these panelists, reach out to us, reach out to me, and we can certainly put you in touch with both Jaco and Nick, who can assist you with your property business going forward. And it's all about profitability. That's what it's about. So until next time, and it won't be next week, it'll be the 15th of August. Stay informed, stay proactive. May your ventures in the world of real estate be fruitful and fulfilling. Take care and goodbye until 2 weeks' time. This is Neil Peterson along with Nick Morgan and Jaco Kropala signing out. Until next time. Thank you, everybody.